get a bounce like you had today, it just keeps on going. Like December 2018. To me, it tells me just simplistically, Bitcoin is just another speculative vehicle. Like the exchange stabilization fund was being used for a lot more than just preventing a technical cliff dive in the stock market.
Welcome back to Risk. I'm Lee, and I'm here with a very special guest, Mr. Dave Kranzler. Dave, welcome to Risk.
Hey, thanks for having me on, Lee. I'm glad to be one of the newer invitees on your new channel.
Oh, it's great to have you here. Why don't you tell the viewers about yourself?
Came out of college and went and worked on Wall Street for 4 years, 2 years at Goldman Sachs and 2 years at a small, kind of an LBO boutique, I guess. I mean, it was a micro cap type firm. I think there was the guy who owned it plus his wife. And then, I don't know, there's 4 or 5 of us who worked there and did the grunt work. So
when you say LBO, you're talking about leverage buyout? Were you at a private equity firm?
Yeah, but it was very tiny. The guy was a wealthy dude from England who had moved to New York and just wanted to set up his own shop.
So it was kind of like a family office.
His claim to fame was he lived across the street on Park Avenue from Henry Kravis. But his firm was a pimple on the butt of an elephant compared to KKR.
Oh yeah, of course. KKR was a monster.
Very bright guy. I learned a lot working there. So,
and I also learned metal space back then at all, or no?
I came out of college in '85, so we're talking between 85 and 89. I mean, no one cared about precious metals back then. I mean, I'm sure there was a small segment, a micro small segment of investors that cared about precious metals. But back then, I mean, all you wanted was for Greenspan to turn on the money spigot, because that's how you get paid on Wall Street. It's not about being bright, and it's not about coming up with clever ideas. Well, in a way it is. You're just coming up with clever ideas to exploit Fed's money spigot. That's really all it is. You come up with, fancy new things. I mean, this was Drexel Burnham was still at its peak back then, or getting ready to take a tumble, as it were, in the late 80s.
The high flying days of Michael Milken, right?
Yeah, the Predator's ball. So
and that was also those were also the days of the Barbarians at the Gate with KKR.
Barbarians at the Gate.
Reynolds.
Yep.
I remember those days well.
And then I was just like, I was at the point where I really needed to get an MBA to kind of advance my career on Wall Street. And so I went to business school for 2 years at University of Chicago and came out. And when I came out, the junk market had just completely gotten obliterated. I mean, there were so-called experts on Wall Street that were predicting the demise of the junk bond market. And I was like, I've always been kind of a contrarian thinker. And I was like, you know what? I'm going to try and go, get a job on a high yield trading desk somewhere. And I ended up at Bankers Trust, and I traded junk bonds for 9 years. And when they got acquired by Deutsche Bank, I wasn't interested in working for Deutsche Bank. And I'm from Denver originally, and I kind of wanted to move back here. That's what I did, and I was just kind of day trading, to figure out what I wanted to do. And a guy that I had become very friendly with through day trading kind of dragged me kicking and screaming into the precious metal sector. And that's how I got into
so you were day trading
2001
at that time?
Oh, no. I was shorting the tech sector. When I left Bankers Trust, well, actually Deutsche, it was, late 1999. And that's when these, right. Yeah, what we have going on right now in the stock market is like 10 times greater in scale and magnitude than what was going on during the dot-com bubble.
The tech bubble.
Yeah.
So you were day trading. Were you working for a firm, or you were trading your own?
No, I was just doing it on my own.
Okay. Those were crazy times, man. That was when I was a full-time trader. I think I got into it around 99. So crazy.
Were you trading from the long side or the short side, though?
All right. So I was with a day trading firm. Most of the guys were trading long side. We traded both. I have always been like kind of a natural bear to my detriment. So I'm always
me too.
Peaks. It's tough. I mean, I think maybe we gravitate toward precious metals and shorting just because we see the world for what the reality is.
Well, and I didn't see the world for what it really is. I didn't really figure out what's going on with, fiat versus real money, et cetera, until I started looking. I mean, when I got into the precious metal sector, I jumped in with both feet. I mean, I was trading during the day, and then I would spend all evening reading everything.
Yep. I was exactly the same way, Dave. I like sequestered myself in my place, And I was doing this full time, and I would read from like the time I got up in the morning till the time I went to bed. I would absorb everything I possibly could. So I can see where you're at there.
Right. I mean, you probably, I didn't subscribe to Jim Willie's newsletter, and he was, just as crazy back then as he was now, but I got some value added out of it. I called it the Jim Willie discount factor, discount about 70% of what he's saying in there, and the rest you're going to, there's some valuable nuggets in his writings, at least back then. I haven't read it in a long time, but the guy who dragged me into the sector somehow was getting a hold of his newsletter, and then he would email it to me, and we were in a real-time chat room, and he'd say, "Hey, I just got Jim Willie," and we'd be like, "Oh, awesome." We'd pour a scotch and we'd both be reading it online at the same time.
That's hysterical. You remember the website Gold Eagle? I think it's still there.
Yeah, it's still around. I've published some stuff on there. That was one of the better commentary and news aggregator sites. Yeah.
But it was sparse information. I mean, there was no YouTube back then. I mean, you either had books or like websites where you would read articles.
Gold Eagle, Goldseek was 321 Gold, Kitco.
If you bought back then and held it to now, you've done pretty well.
Well, I paid $300 an ounce for my first order of 1 ounce gold coins, and I bought Austrian Philharmonics because they had a lower spread premium to spot, and I figured that it's going to eventually it'll get to the point where it's not going to matter what nationality your bullion coin is. They're all going to trade at 100% over quoted spot price.
And looking back, don't you wish you bought a heck of a lot more than you did? Because I know I sure.
Yeah, no kidding. I mean, back then it would have been easy to buy 1,000-ounce bars of silver. I mean, if $4 silver, you wouldn't have even noticed it. I kind of wish I had done that.
I bought a few 100-ounce bars back then of silver. Those were.
Well, I remember I was buying the crap out of Silver Eagles, and I was getting like these packages, a couple times a week. And one time the mailman, I opened the door, or the FedEx guy, he's like, "Geez, what's in this box? We're joking in the mailroom that you've got gold bars in here or something." I was like, "No, they're parts for my my Willie's Jeep carburetor." And at that point, I was like, I better start buying more gold because it's not
doubt about it, right?
Not as bulky.
So that was your background and kind of your bringing up in the precious metal space. Are you still trading outside of the precious metals, or are you just focused 100% on precious metals these days?
Well, I've got a small physical bullion and junior mining stock fund, although it's not just relegated to junior stocks, but it's concentrated in junior miners. And I'm talking about mostly the venture capital, junior, new project development type stocks. And I don't really do a lot of trading in that fund. Fortunately, I put a hedge on earlier in the week, and that offset a lot of the losses that we would have, or at least mark-to-market losses we would have incurred the last couple of days.
Are you trading other things besides precious metals though?
Well, in my personal account, I mostly, because I'm invested in the fund. So my personal account, it's a mix of trying to put bearish bets on a lot of these crap stocks, these insanely overvalued, the modern equivalent of the 1999.com stocks.
Yeah, of course.
And if people are wondering, examples of that, just go look at all of ARK Fund's holdings, ARKK. Just go look at their holdings, and almost all of those stocks in there are the equivalent of the overvaluation that was going on in the .com period. So
it's funny you mentioned that fund, because I have a good friend and we've had many discussions about the markets, and I always relate her to Henry Blodgett. Like, she's the modern day Henry Blodgett.
Oh, Blodgett was just a guy. He was just a cheerleader for Merrill Lynch. I mean, she's going to wipe out a lot of people, or at least inflict damage to their net worth when it's all said and done. I mean, I've been in my short sellers journal, I've been recommending shorting her ARK ETF since it was like around 130, and it closed yesterday. It closed at 98. And so it closed at 99 today. I mean, even with the NASDAQ up, NASDAQ was up almost 1%. I mean, her fund barely flinched. So
not a good sign for that portfolio.
Oh God, no. And part of the problem is with a lot of her holdings is they're illiquid as they are, already. And she owns between 10 and 20% of some of these stocks. She owns the whole entire issue, 10 or 20% of the entire issue. And then there's some mirror funds that mirror her fund. There's a couple out of, I think, Japan, or I think there's one in China. And so, amongst those 4 funds, they probably have 30, 40, 50% of a lot of these stocks. I mean, when we see what happened, what was it, Monday, when the Dow was down 700 or something, when we see what happened, well, let's say this week, a couple of the days this week, not including today, when that happens and you don't get a bounce like you had today, it just keeps on going, like December 2018, or late February to late March 2020, where the market just keeps going down 2-3% every single day. And she's not gonna be able to sell a lot of those stocks.
Yeah. Those are not liquid stocks where you can get in and out of easily. And
right, exactly.
To your point, with so few holders, and they're holding in size. They're not holding like 100 shares, or even
right. 1,000,
2,000 shares. They're probably So when Cathie barred the door when that stock starts to fall, right?
Oh yeah, she's not going to have an exit. I mean, it's a lot of her positions will get completely incinerated, and she won't have been able to sell a meaningful amount. And another thing that she's doing, because there's 2 other shorts that I've been recommending for several months. One is DraftKings and one is Robinhood, and she's owns both. And it's like every day when they go lower, she buys more. And so DraftKings closed today at 31. I started recommending that as a short, like around 43 or 44. And then Robinhood closed at 24. And it was the same deal. I was recommending that as a short in the low 40s. And, she doesn't buy it every day, but on a lot of days where both those stocks were lower, she bought more, and now she's even way underwater on the stuff that she's bought, added to her fund. It's crazy.
She's not having a relaxing weekend, I'll bet.
I think she's like, has faith in God, and so that probably gives her comfort. Probably thinks, if she prays hard enough, the stock market gods will bail her out.
Are you a fan of Reminiscences of a Stock Market Operator?
Oh yeah, God, I read that. I might have been in college when I read that.
Part of the advice in that book was not to do exactly what she's doing, like doubling down on your losses.
Right, exactly.
And I think that's the problem, because people get trained in a bull market to keep buying the dips. And it always works out for them, and then one day it doesn't.
Yep. It's I was just talking about this the other day with someone, and probably going to get sharp bounces like we saw today, up until the point where, and it's mostly retail, and then I think the hedge fund algos, because there's hedge funds that just trade the momentum, and I think when the market starts moving higher, it's not just retail piling into these names, they're buying call options. It's also the hedge funds that are chasing the momentum higher, not with all their capital, but they take some capital and trade, just trade the flow. Probably going to get sharp bounces until these retail guys they should be flush with cash after what's happened since March 2020 to the markets, till their cash, till they burn all their cash and maximize their margin accounts. Probably they're going to keep buying the dips. I mean, it's what happened in the late 90s, in 1999. Early 2000. And then, if you look at a chart that far back, you'll see that we had some sharp bounces starting in early 2000. And then I think it was April 10th, the market started going south and there were no bounces. And there wasn't like a direct explanation or attribution for why that happened. It just happened. It's just one of those things. It's like, you can't explain it. It just happens. Well, you can't explain it. It's because the market's idiotically overvalued.
I don't think I've spoken to anyone in the past 6-7 months who said that the market is not like crazy overvalued.
Well, you're probably talking to people who've been around, they've seen several bull and bear cycles in the markets. They understand how to do analysis. But if you go onto Twitter and just randomly pick some of these guys cheerleading GameStop or AMC, you're going to hear a completely different narrative.
Oh, no doubt about it. You go into Wall Street Bets and forget about it. So what's your take on where we are in terms of the bull bear cycle?
I wish I could say for certain, because then I could.
Of course, I know. What's your best guess? Do you think we've turned the bull cycle off for now? Not that I'm going to hold you to it.
No, I know. It's a good question. I'm actually debating whether to write about this for my next Short Sellers Journal newsletter. If you look at an analog chart, and I keep, I subscribe to the stock charts, it's good and it's not expensive. The data goes way back. So I've got a chart that's saved that goes from November 1998 to April 2000. And then I have a chart that's saved that goes from November 2020 to now. So it's essentially an equivalent monthly period of time. And it's incredible from November 1998 and November 2020 to now. It's incredible how highly correlated the chart of the NASDAQ. So, and it's incredible how highly correlated the two time periods are. And it's not exact,
right? But
it would be interesting to run a regression analysis on it if I could get the hard data. I probably could. It's just not worth my time.
Yeah, of course.
But I mean, you can just see visually how correlated they are. And starting in December 2000 or 1999, and I remember this vividly, the market started kind of going like this, and then boom, you had a peak in early March, and then a sell-off, and then a lower peak in late March, and then boom, it was pretty much all downhill except one big bounce early April. And then you can see, and it's April, starting April 10th, it just looks like an elevator with a broken cable. That's how quickly it went down.
What year?
So this would be March and April 2000.
2000, okay. Didn't we run up into August of 2001?
I think the S&P and the Dow might have, because they didn't have their, but I'm just looking at the NASDAQ.
NASDAQ, okay.
That's where the idiotic overvaluations are for the most part.
Well, now we have stocks that are tremendously overvalued, but I think crypto is an even worse situation.
Funny you should mention that. I have another chart that I've charted out. And so Bitcoin basically started trading in late 2014. And I've got a chart that goes back to when Bitcoin started trading. I'll bet you there's a 70 or 80% correlation between Bitcoin and the NASDAQ over that time period. So we're talking going back to 2014. I mean, that's highly statistically significant. Basically, July 2020, except for a period in early 2021. And that's when Elon Musk and Michael Saylor were pimping the hell out of Bitcoin. Remember?
I remember those. Remember Saylor's big corporate conference that he did online?
Yeah, exactly.
Yeah.
I mean, I think MicroStrategy is a fantastic short. I've been writing about that in my newsletter since then. So there's that one period where Bitcoin diverges positively from the NASDAQ, and then it plummets back down, and the correlation, especially since July, I mean, it's almost 100%. To me, it tells me just simplistically, Bitcoin is just another speculative vehicle. And I saw an article, and it was talking about whoever wrote it had a way of tracking this, but said most of the price gain that you see in Bitcoin is driven by retail buyers of the coins.
No, I'm sure. I mean, humans don't change. I mean, this is classic pattern. Early on in my journey in this, I had read a book by Robert Prechter, and he was talking about like how the market was overvalued and this, but he correlated just like mass psychology to the markets, and it just made so much sense. And I think we're just seeing that play out again in Bitcoin and everything else.
Yeah, there's better books to read on mass psychology than anything Prechter writes.
What books would you recommend on that?
There's that book by Charles Mackay, Delusion of the Masses, or something.
Madness and the Delusion of Crowds, or something like that.
And he goes through all the bubbles.
Yep.
I think starting with the Dutch tulip bulbs.
Yep. I remember reading that book back early on in my journey as well. And I was online chatting with one of the people, and they're like, but the lesson in that book is that we need a central bank to come in and bail everyone out. There are a lot of people out there, they believe in that.
I guess to kind of circle back to your original question about where do I think we are in this cycle, I mean, it depends on what the central banks, especially the Fed, do from here on out. I mean, they're talking taper mode, at least they have been for the month of November, or part of the month of November. And it said right in the Fed minutes that they're going to reassess the taper after December to decide, paraphrase it basically said, we may increase the amount we taper, or we may abandon the taper. It was the taper for November and December were the only two that were etched in stone. If they increase the amount that they taper, I don't think it's any coincidence that they started buying less treasuries and mortgages in November last month, and all of a sudden we're seeing the stock market get really rocky.
Yeah, of course, less liquidity to support it.
Yeah, and I think it tells you just how fragile the stock market is. And that was the same thing when they tapered. I think it was 2018. I'd have to look at the date specifically, but it was when I think Yellen was still in there. I think it started with her, and it was not a big amount. And she was also trying to nudge interest rates up. I remember it'd be like quarter of a point every 6 months or something. It's like, what? Then the Fed actually started printing money again in September 2019. If you remember that, they called it temporary repos.
Yeah.
And then the temporary repos turned into monthly repos and then indeterminate maturity repos. It was basically a cover for QE, but effects of the previous taper and slightly hiking up interest rates, you can see the stock market started tipping over probably in January before COVID was really even a thing back then. I'm certain that was the fallout from when they tried to taper originally and had to stop because the stock market was, remember that was December 2018 when the S&P fell almost 20%. And then on December 26, Powell came out and said, okay, no more, we're gonna support the markets, don't worry.
They're really good at kicking the can down the road. That's probably the thing that they're best at.
Right. And I do think at some point with the money printing, it's going to run into the law of diminishing returns, how that would apply to the markets and the money printing. At some point, the money printing there's going to be so much money that's been printed, it's going to lose its traction. And we saw that in the Weimar period in Germany. And what that leads to, complete loss of confidence in the currency. And so it won't matter how much money the Fed prints, it's not going to help the markets. The rug's going to already be pulled out from under it.
That's the classic pushing on a string.
Exactly. I just used that term within the last 3 or 4 weeks to describe this. So that's what I think will happen, but who knows?
Do you have any time frames on that, or that's really anybody's guess, right?
It's anybody's guess. Today, if you look, the S&P, and I think it's the Fed that's propping it, the S&P has been supported by the 50-day moving average since July 2020. And really longer than that, but it's pinpoint since July 2020. The S&P gets down to the 50-day moving average, boom, it pops back up and goes higher. It goes on to a new high. And that's where it bounced today, was at the 50-day moving average. So we'll see if it continues from here. But I mean, it still tells me that the Fed is in there making sure the stock market doesn't collapse because, the problem they have, and they're not idiots. They know the stock market's stupidly overvalued, and they know that they're the reason for it. The problem is that the entire viper's nest or web of financial assets, especially derivatives, is predicated on the equity value that sits below it. So you got junk bonds, investment grade bonds. You got, I call it junk bank debt. It's the leveraged bank debt that was issued to do a lot of the buyouts we've seen in the last several years. And then, so all of that stuff sits above in the capital structure, above the equity market, above equity valuation. And then you got derivatives wrapped all around that. And so if the stock market collapses and stays collapsed for an extended period, all that stuff's just going to be incinerated. It won't have, it's going to lose its value because the value of the equity that sits below it, well, it gives people confidence in the markets, but it also supports the valuation of everything that sits above it.
I mean, everything's tied to some asset when they make loans or whatever else. So, I mean, if those assets start to collapse, it's just a house of cards, right?
And people point, when you're valuing assets, the first thing you look at is, okay, well, where is a comparable valued in the stock market, right? And the same thing with housing value. The housing stock is really a financial asset because you got 90% of new home buyers use a mortgage and something like 70%. And that number may be stale. It may be higher than 70% now. I'm sure it is because, most people can't afford a home without taking out a huge mortgage buy it. So, but let's just say it's somewhere between 70 and 80% of existing home buyers use a mortgage. Well, a mortgage is a financial asset. And so the value of that house is predicated on your ability to take down a financial asset to pay for it. So that's why I say the housing stock is a financial asset for the most part. And I compare that to the early 70s when people bought a home, they would put down at least 50% down payment on it. I mean, you couldn't get a mortgage there wasn't Fannie Mae and Freddie Mac to give you a 3% down payment mortgage so that when all said and done, after all your closing expenses and moving expenses, you're essentially underwater on that mortgage unless the value of homes keep rising. Well, let's let the stock market do what it's going to do. Let the Fed stay away from the stock market and stop printing money. Let's see what happens to the stock market and then see what happens to home values.
Do you think that the Fed is actually going into the marketplace and buying futures on the NASDAQ and S&P, like the much rumored plunge protection team? Or do you think they're just supporting the market through monetary policy?
Well, there's two things there. The first is, yes, the Fed is supporting the stock market with its monetary policy. and it damn well knows it. But the plunge protection is that, I mean, that's a real entity. That's the Working Group on Financial Markets that was established in 89 by Reagan by an executive order. It was set up to be able to use the exchange stabilization fund to stabilize equity markets so that something like what happened in 1987 doesn't happen again. And so, I mean, yeah, there's real validity. It's not conspiracy theory that there's an official entity and the Fed sits on the board. The chairman of the Fed sits on the board, or a proxy for the chairman of the board from the Fed sits on the board of the Working Group on Financial Markets. What I kind of noticed when Robert Rubin was made Treasury Secretary, it kind of felt like the Exchange Stabilization Fund was being used for a lot more than just preventing a technical cliff dive in the stock market.
I said it's one huge conspiracy that people don't even know about. It's not even theory. I mean, it's just like
it's conspiracy truth. I mean,
exactly.
The Exchange Stabilization Fund was set up in, I believe it was 1934. It was created by the Gold Reserve Act. And they set up the Exchange Stabilization Fund to stabilize foreign exchange trading. At the time, gold was also used as money, which means that the Exchange Stabilization Fund was also in there manipulating around the gold market. People who don't believe that there's official entities that are manipulating the gold market, well, it's hidden in plain sight. And just go read the Gold Reserve Act. I mean, you can pull it up on Wikipedia. But yeah, I think what happens is, and there's no way to know this for sure, but I've had these conversations with people going back 20 years. I think what happens is when the stock market starts to really head south quickly, I think the Exchange Stabilization Fund starts putting a bid in for E-mini S&P contracts.
Okay.
Because if you've got a big enough bid in the E-mini market, it doesn't take a lot of capital. It's kind of like the tail wagging the dog. It doesn't take a lot of capital to make your presence felt as a buyer. And I remember, because I trading at a day trading place for a while back in early 2001, late 2000, and they had incredible technology set up, and there was a screen that you could pull up, and it plotted real-time movement in the E-mini contract, a line chart, versus the cash markets. And the E-mini always was slightly ahead of directionally, it was always slightly ahead of where the cash markets were going to go. And so that's why people think it's the E-mini market, the S&P E-mini market, where the Working Group does a lot of its activities.
Do you think they're actually making money, or do you think they're losing money doing it?
They're making a ton of money. I mean, there's guys that you can interview who have, and I think Rob Kirby, the Exchange Stabilization Fund is huge. I mean, it's essentially insider trading, right? You know what the Fed's going to do. So when the Fed says, oh, we're going to ease monetary policy, the Working Group has probably already positioned the Exchange Stabilization Fund.
I'm sure they are, and I'm sure most of the members of Congress are too.
That's right. And the thing about it is you can't get any information on what the Exchange Stabilization Fund holds. There's
no FOIA request on that one.
It's actually, the Working Group is actually a subsidiary of the U.S. Treasury.
Okay.
So that's how they separate its role in the markets from what the Fed is doing, even though the Fed sits on the board.
Well, there's always been a cozy relationship between the Fed and the Treasury, hasn't there?
Right, exactly. And again, this isn't conspiracy theory. This is all truth. It's facts. You can go, people who are watching this and might not believe it, will go do your own research.
Dig in yourself and find
yeah, don't take it from me. I mean, that's how I learned about all this stuff. I did my own research. I don't just go on Zero Hedge and look at the articles and say, oh, that must be what's really going on. No, I make sure I verify the information that's conveyed in alternative media sources like Zero Hedge. I want to confirm it for myself.
No, you have to. Absolutely.
If I can.
It's not always easy to do, but it's definitely a wise thing to do. People make mistakes. Even, they may have good intentions. They may think they're putting out the right stuff, but sometimes they don't.
Right.
I've had Klaus Schwab and them talk about this big, great reset. I mean, they all know that the game is probably near its end.
The idea of a reset has been rampant in cyberspace, right? It's all over social media. Oh, there's a reset coming. Well, I don't really know exactly what that means and what it looks like. And I don't know who's going to, push the buttons on the reset. I mean, if I would say the China-Russia consortium probably would have the edge on something like that. But then, for a global reset to happen, the way that a lot of people envision it, you'd have to see, you'd have to have China and Russia and the US and the EU all cooperating. And I don't know that that's possible.
No, that makes
I mean,
sense.
history tells us you can't have an overarching oligarchic structure that rules everything, right? Because eventually someone who's part of that circle wants to be the head honcho.
Usually a few people
Human
want to be
nature.
the head honcho, and they fight amongst each other.
Right. I mean, it's human nature. So yeah, I think the guys who are running the central banks and the BIS, and not the front men in the governments, not the congressmen and not the president, but the guys that are behind them, the handlers, the guys that are really making policy and pulling the strings. They know this thing's going to collapse eventually. They know that eventually the monetary system is going to reach the point of diminishing returns where money printing it's going to collapse anyway. The question is it going to take 10 months or 10 more years? Who knows? I mean, I'm sure you feel the same way when I jumped into this.
It's the same story back then as it is now.
Right. Well, I mean, I would have never thought, I was early on predicting the demise of the housing bubble back then. I would have thought what happened in 2008 to all the markets, I thought that might have been it, but obviously it wasn't. That's when the Fed really started cranking up, and all the central banks, not just the Fed, started cranking up the printing press. Gave us what we have now when you look at this abortion out in the stock market.
Well, one thing that's different now, Dave, I don't know if you've seen this too, but the whole inflation narrative is really getting into the mainstream media. People are like really noticing it. I mean, it's been going on for a really long time. But what my point is, I mean, inflation's been going on for a very long time. I mean,
yes.
Since
Absolutely.
both of us were probably children. I mean, we've seen housing prices go up. We've seen the cost of education go up. We've seen just the price of cars. Everything has been creeping up. It's just getting kind of like a crescendo feel now.
Well, and especially since 2008, which is when the central bank started printing the crap out of the money supply. Yeah, I agree. I mean, I think that's one of the reasons Powell had to wave the white flag on transitory, because word was getting to him that everyone thought he was an idiot because he thought inflation was going to be transitory. I mean, I don't think it's not just not transitory. I think it's going to 6 months from now. I think we're going to wish we had the inflation rate we have today.
Yeah, I'm scared for the same thing, actually. I mean, I'm worried about going to the pump and seeing, $10 a gallon.
I'm paying $4.20 a gallon now for 91 octane, and that's pissing me off. And you're right. It's going to get worse. And it's the supply chain situation is exacerbating the problem. That's not the cause of the problem. The cause of the problem is the money printing and the devaluation of all fiat currencies, not just the dollar. Just the dollar's been, even though it's not evident from looking at a short-term chart of the US dollar index, because we've had a bounce, but the Fed has been the most aggressive at printing money.
Someone I forgot who it was, but they made an interesting point. They said that people are realizing that prices are going up and they're starting to buy more and more goods. So that's causing a crunch on the supply chain on top of everything else.
That too. Yep, I agree.
Is there anything that you want to add to the conversation, Dave?
I would just caution people to if you harbor the belief that the stock market's going to keep going higher forever, be in for a rude awakening.
No doubt about it. So how people? Why don't you tell us about what you do? I mean, and how people can subscribe to your product?
Sure. So my website is investmentresearchdynamics.com. I think if you Google my name, that's probably that website probably comes up. And then there's links on there that'll give you information about my mining stock journal and my short sellers journal. And then I run up a small private bullion and mining stock fund.
Can people invest in that, or is that a closed fund?
Accredited investors can invest in it. Yeah.
Dave, thank you so much for coming on. It's been a fascinating discussion, as I figured it would be.
Hey, Lee, thanks for having me. Let's do it again.